But that price filters into everything you buy because everything involves transportation. In other words, if gasoline's going up, diesel's going up.
In this interview, Jim Rickards discusses the disconnect between Wall Street's expectations of decreasing inflation and the reality of its persistence. Despite the Fed's earlier projections of 3% interest rate cuts by the end of the year, inflation has not abated as anticipated. Rickards delves into the history of the Fed's rate hikes starting in March 2022 and Wall Street's anticipation of a pivot to rate cuts, which has consistently been pushed further into the future. He emphasizes that inflation, as measured by the CPI, peaked at 9.1% in June 2022 and has not significantly declined since then, contrary to expectations. Rickards highlights the role of rising oil prices in driving inflation and explains how this impacts consumer goods due to transportation costs. Overall, he suggests that the Fed's plans for interest rate cuts are not feasible in the face of persistent inflationary pressures.
And this was at a time when the Fed was saying inflation is coming down, Wall Street's inflation is coming down, they're going to cut interest rates. The Fed was still saying, we expect 3 interest rate cuts between now and the end of the year. I mean, they were saying this in, the beginning of April, 3 interest rate cuts between now and the end of the year. Everyone thought that there would be no cut at the May meeting. Nobody thought that. But you still had June, July, September, November, December. That's 5 meetings. The Fed's on a crazy schedule. They don't meet every month. It's like every 6 or 7 weeks, but 8 meetings a year is what it boils down to. So there is no meeting in August, no meeting in October. But so you had 5 meetings, June, July, September, November, and December. And you're talking about 3 rate cuts. Okay, no problem. 5 meetings, 3 rate cuts. That seems to work. Except, and this is what we said a while ago, inflation is not coming down. Now, that's the story. That's the narrative. That's what Wall Street likes to talk about because they just want to sell your stocks. So it goes by a couple of names. The first name is the pivot. When would the Fed pivot from rate hikes to rate cuts? That's the infamous pivot. They stopped hiking rates in July 2023. So that is true. They're just on hold for the time being, but they're not even close to a rate cut, and that's what we've been saying. But Wall Street started talking about this 2 years ago. It was the summer of 2022. Remember, the Fed started raising interest rates in March 2022. At the time, rates were zero. When I say rates, we're talking about the Fed funds target rate. So it's a really short-term overnight rate. We're not talking about 5-year notes and 10-year notes. Those are different. But the overnight rate that the Fed targets, it was zero at the beginning of March 2022. Well, they just started hiking in March 2022. They finished in July 2023. So about 15 months of rate hikes, and they got it up to 5.5%, which is where it is now. But the Wall Street started talking about the pivot in the fall of 2022. Now, they didn't say it was going to be that month, but they said, early 2023, the Fed's going to cut rates. Well, then that turned into like mid-2023, and then it turned into late 2023, and then it turned into early 2024. Here we are in mid-2024, and they were still talking about it, but they've been wrong for almost 2 years, and we said they were wrong. We didn't say the Fed was going to raise rates, although you can't take that off the table, but we said they were definitely not even close to cutting rates. So what's the kind of backstory on inflation? Inflation peaked in June 2022, 9.1%. And by the way, Matt, let me just do a quick footnote on the definition of inflation. It shouldn't be complicated, but people make it so. When I talk about inflation, I'm talking about the Consumer Price Index, CPI, comes out monthly, computed by the Bureau of Labor Statistics. Consumer Price Index, and it's measured on a year-over-year basis. So you look at the monthly index and you say, what was it a year ago that month? And then that's it. That's how they compute it. Now, that peaked in June 2022 at 9.1%. By the way, the highest since the early 1980s. You got to go back over 40 years to find inflation that bad. It was 9.1%. By June 2023, so a year later, it didn't come down to 3%. So, remember after we marched in Baghdad in 2003, that President Bush went to the aircraft carrier and they had that big sign, mission accomplished. Well, the mission was not accomplished. You had basically 2 years of massacres in Iraq between Sunnis and Shia. And finally, the U.S. pretty much got out of there under Obama, although we still have bases there. But the Fed was putting up the mission accomplished banner. Well, it wasn't mission accomplished. Yeah, 9.1% down to 3%. Nice job. But it wasn't 2. I mean, they were trying to get to 2. They had what they call the last mile. How do you get that last, little bit down? Well, the problem is it's been going up ever since. So, okay, 3% in June 2023, but by August, it was 3.7. And then in September 2023, it was 3.7. And it's been up and down, 3.2 some months, 3.4. The most recent reading was 3.5. So here we are that was from March 2024, that data came out in early April. So here we are 9 months, almost 10 months after that low of 3% in June 2023, and it's higher. Inflation is higher than the prior month, the prior 6 months, and at this point, the prior year. So, inflation is not just stuck; it is stuck, but it's actually been going up. And so, all you have to do is look at that and say, all right, well, if you're worried about inflation, if that's your job, you're the Federal Reserve, your job is to get inflation under control. And inflation has stopped coming down and is starting to go up. How on earth are you going to cut interest rates? Well, the answer is you're not. You can't do it. So even at the March meeting, Jay Powell was like, well, we've seen good data, and we need a little bit more. He said, we're not quite there yet. We're just about there, but we need some confirmation. I think was the word he used. So a couple months like that, and then boom, we're ready to cut rates. They never got the confirmation. It went up. And why was it going up? Well, oil prices were a big contributor. When oil prices go up, it filters through the whole supply chain. So gas at the pump is an obvious one. By the way, if you go to AAA gas prices, just Google AAA gas prices. AAA has a really good chart, and of course they get their finger on the pulse. And they show regular gasoline nationwide average. Now, they can break it down 100 ways, but I just look at regular gasoline nationwide average. That number is higher than it was last week, last month, and last year. It's been going up, of course, just in time for the election. This is not something that Joe Biden particularly wants to see. So, but it's not just gas at the pump. That's the most visible sign. People, they know. You pull up at their gas pump and say, price went up again. It's costing more to fill up my Ford F-150 or my SUV, whatever it is. But that price filters into everything you buy because everything involves transportation. In other words, if gasoline's going up, diesel's going up, well, everything moves by truck or train, as the case may be, but mostly trucks. Everything you buy in the store, every loaf of bread, canned goods, fresh vegetables, whatever, it gets there by truck, and if the trucks have to pay more for their diesel, then they have to charge more for the freight, and then someone's going to have to raise the price of goods. So because of the transportation effect, which I just described, and a lot more, airfares, jet fuel, etc.,